Continue this conversation, because if you're trying to figure out where the macroeconomy is going, or maybe what the Fed is going to do, you want to look at the banks, because banks know a lot about things: loan demand, credit availability, what people are doing with their money. And few companies know as much about banks as KBW. They are a 62-year-old investment bank focused on financials, part of Stifel Financial. Tom Michaud is the CEO of KBW. Tom, great to have you on.
Thank
An important conversation.
Yes.
I think to Karen's point, here's the thing. Everybody's going to be waiting for this Fed easing cycle, but it looks like the bond market has kind of already done the job of the Fed for it.
Yes. Well, the first thing is I would watch the yield curve and the shape of the yield curve. We're watching it very carefully for the banks. So this past week, we had the 2s10 stop being inverted for a short moment in time. This was the longest period of time in 47 years that yield curve had been inverted. The one that matters most for the banks is still a little inverted. That's the 3-month, 5-year. That's the longest inversion in close to 70 years.
Wow.
So this is.
I'm sorry. What does that mean then in plain English? Whenever I hear first time in 70 years, by the way, got my attention.
Exactly. So here's what it is the biggest component of bank earnings is net interest income, which they earn on the spread. When the yield curve is inverted, assume these banks are operating with a big headwind blowing at them. It's a hard market when that happens. When you get a flatter or a regular shape to the yield curve, that means banks can borrow short and lend a little longer and take advantage of that duration. So banks have been operating in a very hostile environment. If you were to say to me, in general, what's a tough environment for banks? I'd say inverted yield curve after interest rates just went up a lot. That's just what happened. They're actually about to catch a break. And we believe that the low quarter for net interest income, the biggest component of bank revenue and earnings, was in the second quarter that just passed. Now it's going to start getting better. And it's going to get better slowly, but it's going to get better.
Well, this asset class, though, has had an enormous run. It's as if the market has anticipated this. But there's a lot of different things that have been triggers for banks. I think a lot of it is less regulatory pressure. I think there's been dynamics around this. There's certainly, we're well past the SVB headaches of about 15 months ago. Is it a credit story that I think people have a lot more confidence in banks, because it seems that the one brain cell is commercial real estate gets a little bit more of a lifeline in a world where the Fed is easing back off. But either way, the presumption was there was a lot of credit risk out there for banks, and we're just not getting it.
Well, first of all, the credit story has been far better than everybody expected, and everybody's been waiting for a shoe to drop. The shoe hasn't dropped. Not only is credit not getting away from the industry, credit is still better than average right now. We haven't even gotten back to normal. We're still better than normal. And last week, we had 100 banks in New York for a conference. We followed all the bank earnings in the second quarter. They, as a group, said nothing that makes you think we're going to get a harder landing. As far as we see, from our lens, soft landing still seems to be what's going to happen.
But what happened Friday and yesterday, then? I know some of your traders. What are they saying to you about what the heck happened?
Well, I was listening to your conversation. There's a delinkage between these macro forces, and it scares everybody. But the reality is it didn't affect the real economy yet in the United States. I mean, there is a story of a slowing economy. That's what the Fed's trying to do. And they'll eventually win, because the Fed usually does. So the economy is slowing, but we're nowhere near crisis, in my opinion, which means I would buy these stocks on a dip, would be the high quality ones.